Hello and welcome. This is my presentation on how to achieve extraordinary returns with out-of-state real estate investing. I have this saying that I've trademarked, and it's live where you want, invest where it makes sense. And that's really true. And today I'm going to share with you how that is true and what to look for when you're investing in real estate, give you a bunch of tips and guidelines, and show you exactly how I've purchased real estate from 3,000 miles away from here in Southern California to markets as far as Florida, Michigan, and Atlanta, Georgia. So sit tight. I'm going to go through this quickly but in detail. This presentation normally takes 2 hours, but I'm going to try and condense it down to about 40 minutes or so. So I'll do my best. So who am I? My name is Marco Santarelli. Many of you might know me. Some of you might know my company, Norada Real Estate Investments. But I'm a full-time real estate investor. I'm actually an investor in multiple asset classes, but real estate is by far my favorite. I'm an author of many reports and chapters and articles that have been published in different places. I have a new book coming out very soon called Passive Real Estate Investing, so I'll tell you a little bit more about that here shortly. I'm the CEO and founder of Norada Real Estate Investments, and my company is a nationwide provider of turnkey cash flowing rental properties. And this is the core business of what I'm involved in and what I do and what I invest in myself. I have purchased and renovated my own property when I turned 18 years old, and I knew I wanted to get in real estate. I couldn't until I was of legal age, and so at the age of 18, I could legally purchase a property, take title, and get financing. So that's when I purchased my first end unit townhome. I renovated it, I leased it out, managed it myself, held on to it for a number of years. I got good cash flow from it. It appreciated. One of the mistakes I made early on, and something I'm going to share with you that I hope you don't repeat, and that is this. Unless there are rare exceptions, you never want to sell your real estate. That doesn't mean you're going to keep every property you have, but you're not going to openly sell it just to take the equity out. You want to put that equity back to work. And that's one of the lessons I learned long ago, not realizing what I didn't know. But I ultimately built a large portfolio over the years. And so fast forward to 2003, 2004, I started building up a very large portfolio. In fact, in that first year, in 2004, I actually accumulated 84 units in that 12-month period. So I had 84 doors to add to my real estate portfolio. And I'm going to show you how I did that because I did that all from Southern California, and I didn't purchase a single property in the state of California. It was all out of state. I'm the host of the Passive Real Estate Investing podcast, and it is a top-rated podcast on iTunes, Stitcher, iHeartRadio, and I encourage you to subscribe. I get a lot of great feedback from it, so hopefully it'll continue your education because I'm all about education. I believe you should be a lifelong student of anything and everything that interests you, and especially stuff that you're investing in. The passive real estate investing show is what we call the show where busy people learn how to build substantial passive income while creating wealth for the long term. And that's what it's all about. It's about passive income and creating wealth. So that domain name, just to give it to you up front here, is passiverealestateinvesting.com. That's where you can find it. So let's move on. So let me ask you a question. Here's some food for thought. Finish this sentence. Ignorance is blank. What would you say? I think most people would say that ignorance is bliss, and I think that's at least what we're told and indoctrinated to believe. But that's a myth. That's a falsehood because what I like to say is ignorance is expensive. Ignorance is expensive. The thing is what you don't know can hurt you. What you don't know can be very costly. It could cost you money and it could be an opportunity cost because the more you learn, the more you earn. I'm sure you've heard that before. The more you learn about your craft or the more you learn about investing or what you want to invest in, the more successful you're going to be. And you'll be able to identify bad deals from good deals and good deals from great deals. And you'll be able to ask intelligent questions, not just of the investment itself, but the people you're working with, the team you surround yourself with, your CPA and your attorney. If you can maintain an intelligent conversation by asking smart, intelligent questions because you understand what you're doing, or at least you understand what you're investing in, then you can identify better opportunities and avoid making mistakes. So I've learned over the years that ignorance is expensive. And so this is why I'm an ongoing perpetual student. I'm constantly traveling to go to mastermind meetings and workshops and boot camps um, and reading books and articles and just networking with peers in my industry because I want to learn more and I want to know what I don't know. So keep that in mind. Now let's talk about a real estate investing myth. I think we need to kind of get this one out of the way for us to open our minds to what I'm going to talk about beyond this slide. So there's one thing that the media talks about a lot, and people in general, they always talk about this real estate market. But what exactly is a real estate market? You see, the media talks about it in terms of a national real estate market because when they talk about real estate on the national news, they're talking about this untangible real estate market as if the entire country was one market, and it's not. The United States is made up of over 400 MSAs, or metropolitan statistical areas. And so it's impossible for us to have one national real estate market. You can't point to it. You can't show me where this national real estate market is. You see, the reality is that all real estate is local. Everything is local. Every local market you can think of or you could visit has its own politics. These are all dimensions of every real estate market. So whatever goes on locally affects the real estate market, the policies, the zoning laws, uh, the infrastructure that's built, additional roads, highways, freeways, etc. Those all affect real estate and real estate values. They affect land values. And so you have to understand that there's this trickle down effect um, that comes from the local politics and the factors that happen within a market. The local economy, obviously, if there's jobs in a local market and people are moving in, that's going to drive demand for housing. So when you have a good economy and you have jobs and people are earning a living, they're able to pay for housing. They're able to pay for their rent. Local business environment, is the market conducive to local businesses? Does it drive business growth? Does it increase the number of jobs, keep unemployment low? Does it increase wages? That local business environment is what brings jobs in, and businesses are employers, so they help to grow the economic base. And then of course there's the local supply and demand. Every market has a fixed amount of inventory, and that inventory grows based on new inventory that's brought onto the market. But that's also heavily affected by the demand. If there's demand, then builders build more housing. And there are a lot of markets right now that are suffering because there's very strong demand for housing, but there's not enough new construction to build new units, new housing units. So household formation is lagging behind demand right now across the country in many markets, if not most markets. So the local supply and local demand of a market will affect rent rates, pricing, and virtually everything else you can think of. Okay, so moving on, your local market may not be the best. In fact, for most people, and probably most people listening to this presentation, your local market, the area that you live in, and everything probably within a 1 to 2 mile radius is probably not the best place to be investing. And unfortunately, we see a lot of investors focus on their local market. Why? Because the so-called gurus tell them to invest within a 1 or 2 mile radius of their home. And it's kind of it's a crippling comment. It's really bad advice because you probably will do better in most situations by looking beyond that 1 or 2 mile radius from where you live. Because the reality is that most of the best deals are located in different markets around the United States. Now, there are different factors that affect markets, and these are the things that I like to look at and we look at as a company, and what I'd like you to look at. So what are those differences? There are different drivers in terms of what drives a market and makes changes, both good and bad. For example, there are Jobs being created in a market is a driver. Lack of housing, lack of land to build new homes. These are all things that affect pricing and availability. Take San Francisco for an example. There is limited supply of land to build, so they're kind of landlocked between the ocean and everything surrounding it. But there's a lot of demand because there's a ton of jobs there. So people want to live there, but unfortunately, that strong demand is pushing prices through the roof. I heard recently that it's going to be over $1 million to get a single one bedroom apartment. For example, take San Francisco. San Francisco is essentially landlocked. You've got the ocean on one side, and you've got all this these built out suburbs and cities surrounding it. So there's no more room to build. You can only build up. But because there's strong demand, because there's a lot of people moving there and living there because of the jobs that are in the area, it creates this artificial pressure on prices and pushes them up. So you've got all kinds of different market drivers that affect the economy. And then there's, of course, the market cycle. This could be an economic cycle. This could be a real estate cycle, but that will affect where you're at in a particular market. Are you at a peak or a trough or somewhere in between? And so that might affect when you get in or when you leave a market for a better market. So it's important to pay attention to market cycles because everything is cyclical, some markets more than others, and I'll touch on that here in a minute. Then, of course, there are median prices. Some markets you could pick up a 3 bedroom, 2 bath home for 80,000, 100,000, and then you could take a similar property, a similar home in another market, and it may be worth 7, 800,000, $1 million or more, like what we see here in Southern California. So median prices will change from market to market. And then, of course, the median rent will change too. You could rent a 3 bedroom, 2 bath home here in Southern California for $3,500, $4,000 a month, but that same home is going to be closer to $1,500 a month in some of the other markets that we operate in. So again, that's a critical thing to look at, and the ratio of these two, which we'll talk about here in a minute, is also an important thing to look at least initially. And then all that ties into affordability. Is it an affordable market? Is it affordable for homeowners? Is it affordable for renters? Is that affordability drawing people in and increasing demand, or is it driving people out because they can't afford to live there? So they just drive as far out as they can until they can afford. Otherwise, they just leave the market and find another place to live and another place to work. Property taxes, that varies dramatically from state to state and county to county, and that doesn't necessarily affect our decision or my decision to invest in a particular market or property, but it could and it can. It just depends on whether the median rent will cover all those line items, those expenses on your profit and loss statement. And last but not least, the rent to value ratio, and this is something that I was alluding to just a minute ago, between the price or price range of what you would be buying relative to the rent that you can get for it. And I'll explain that here more in just a moment. So what's the solution? The solution is to invest in the best markets that produce the best returns. I mean, it's just simple. And think about it in terms of a different asset class. Let's say you were investing in the stock market. You don't care whether Coca-Cola is in Atlanta, Georgia, where their head office is, or whether they're an hour drive away from you. If you think Coca-Cola is a good investment, they'll pay good dividends, it has good upside potential, then you would probably base your decision on the rates of return, the soundness or fundamentals of the company, and probably a few other factors. But you're not going to base your decision based on geography. That just doesn't make sense. So it doesn't really matter whether Coke is in Atlanta or in Southern California or in Detroit, Michigan. You're basing it on how well your investment will perform, where you're going to get the highest yields and the highest return. And so that's the way we look at residential real estate as well. We choose markets based on the fundamentals and the economics of a market. And that's what you should do too. And that's what I'm going to talk about here today. So let's talk about investing locally versus investing long distance. Why do investors like to invest locally? Well, for the most part, it's because it's a psychological thing. The first thing is there's a comfort level. Where you live is what you know, and you have an idea of what the different areas and neighborhoods are like, and so you know what a good area is versus a bad area versus an up and coming area. And that's all well and fine. However, that knowledge can be gained regardless of the market you're looking at. So investors choose to invest locally within their backyard, as I like to say, meaning within an hour or two of where they live, because it's a comforting thing. It's a comfort level. Other people choose to invest locally because they're more of an active, not a passive real estate investor. And so they like to do it themselves. They have a do it yourself mentality, and they like to find the ugly property on the nice street or maybe a distressed seller situation, pick up that property and clean it up, or maybe replace the paint, carpet, appliances, and maybe do some more. Maybe it's an incredibly deep scope of work and it requires a lot of renovation. If you like that kind of stuff, that's all well and fine. But if you're buying to fix and hold uh, in your local market and the numbers make sense, that's the key. Do the numbers make sense? Then go ahead and do it. But again, for many of us, we're too busy for that. We don't want the brain damage. We don't want to go through the learning curve. And frankly, we just don't have the time to do it. So for us, the do-it-yourself model is not ideal for many of us. Now, there's also the psychological element of control. Is there really more control? Do you really have more control if you own a property within an hour radius of where you live and it's being professionally managed, not necessarily by you, but ideally from a professional management company? Or do you have more control if that property, same property, similar property, is located in another market where you're going to get better cash flow, a better yield, maybe better growth potential? I think at the end of the day, it's really the same, because if you're managing your managers, if you think of yourself as the CEO of your company and your property manager is, let's say, your COO, then your chief operating officer, then you're going to be just working with those frontline managers and let them manage your assets. And then the other factor is it's exactly what I just talked about. You don't always find the best deals locally. It's just not going to happen for a lot of us, especially those of us that live in the coastal markets of the United States and many of the expensive markets all around the country. Now, when you invest long distance, what are those advantages? Well, like I said, often you will find, and I can show you all day long, better returns, better cash flows in markets that are located in strategically located areas around the country. Often they're the Midwest down through Texas and all out towards the Southeast and parts of the Northeast. Beyond that, it really comes down to looking at smaller and tertiary markets, which I'm not a big fan of. We stick to what we call tier 2 markets, which are not the major markets like New York, Los Angeles. Those are tier 1, and not the really small towns and small cities that are far out suburbs or just independent towns located away from major metropolitan centers or larger metropolitan centers. Investing long distance allows you to achieve stable equity growth when you get away from those cyclical markets on the coastal markets, and you can be in a market that has slow, steady, reliable, predictable growth in terms of price appreciation, which really should keep it lockstep with real inflation rates. Then you can sleep well at night. You have that stable equity growth. And then, of course, there's the lower risk element. You see, the problem with expensive markets is the land value is so high that the downside risk is higher, and it comes down quicker. The property values come down quicker when you reach a peak in a market cycle, and you see property values start to come down. Well, it's the land values that come down fast first, and you see the biggest swings in prices. So I think you mitigate your risk by investing in a diversified real estate portfolio across 3 to 5 markets in well-chosen markets around the country. All right, let's take a look at the big picture here. So we like to break markets up into 3 general categories. The first one is what we refer to as a cash flow market. Examples would be Birmingham, Alabama, Huntsville, Alabama, Memphis, Tennessee. These are 3 of probably 4 or 5. And we refer to these markets as cash flow markets. And the reason for that is because they're slow, steady, and effectively boring markets. They are just a great place to preserve your capital and turn it into cash flow from these little money machines, these cash flow generators. And we like these markets as a starting point for investors because it gets them going on the path to passive income with a good rate of return. The cash flow markets are ideal because they're very predictable, and although you don't see a lot of appreciation potential there, they're just going to keep up with inflation. And so they're very easy to deal with, very easy to get in and out of, very easy to understand. The second type of market is on the opposite end of that spectrum. It's what we refer to as a growth market. Examples of that today, as you know, real estate is dynamic and it keeps changing. But what we've seen in recent years and what we're seeing going forward are markets like Atlanta, Dallas, Houston, and San Antonio. These markets have been experiencing above normal rates of appreciation, and we'll probably continue to see that for the next year or two, maybe three, but at least for the foreseeable future. So these growth markets give you less of a return, lower cash flow on a per door basis, but they have stronger appreciation potential. So those people who are not necessarily speculators, because we don't want to be a speculator, but those people looking for that growth will focus on these markets because they have very strong economies, strong job markets, they have strong population growth, and all those factors are just driving the housing market. Probably a little bit faster and higher than what we'd like to see, but they are growth markets. And then we have something in the middle, something we refer to as a hybrid market. And these are markets that are not quite as attractive in terms of cash flow as the cash flow markets, but they're appreciating very well and not as fast or as much as the growth markets. So they're kind of somewhere in the middle. And this is also a place that new investors will start, or we recommend, and those are places like Indianapolis, Jacksonville, Florida, Kansas City, Missouri, and the greater Chicago market outside of Cook County. That would be outside the main perimeter of that county. So these are the three main types of markets that we classify and that we have investment property in. And these are markets I've invested in, and these are markets that I suggest you look at. And of course, there's other markets, not just those. So let's start off by looking quickly at some macroeconomic factors. So when you're selecting market, there's four main things you want to look for. First is the stability of the market. Ideally, you want to be in a stable market, not a volatile market. And another way to look at this is a linear versus cyclical market. And I've talked about this a couple of times now, but what does that mean? What exactly are they? Well, a linear market are those markets typically in the interior, towards the interior of the U.S., away from the coastal markets, that grow year over year on average anywhere from 3 to 7%. And I'm talking about the market as a whole. Of course, that's going to differ as you get more granular in terms of areas and neighborhoods. But as a whole, a linear market will have a very smooth growth curve. If you look at a historic price appreciation graph, if you go back, several decades. So it does have a wave, but it's more of a smoothed out wave that moves towards the upper right. In other words, it's appreciating moderately, 3 to 5 to 7%. A cyclical market will appreciate and depreciate much faster and sometimes in double-digit fashion. So the coastal markets, for example, there are years where you will see markets in California and Florida, etc., appreciating 10 to 13%, sometimes more, and that will happen for 2-3 years in a row, and then all of a sudden those markets become overpriced and unaffordable, and the numbers don't make sense anymore from an investment perspective. And at the opposite is true too. When those markets depreciate, you will see property values come down quickly and dramatically. And I've seen this happen in specific markets like in Southwest Florida and Riverside, California, as well as actually in Las Vegas and Phoenix. So keep that in mind. You want to focus on stable markets. You also want a market that has a diverse and stable economy. So you want a diverse job market. You don't want it to be a one-trick pony market. You want there to be jobs that come out of many different industries across the spectrum. And that adds to the stability and a good foundation to that market, because as things change in the global market as well as the national market, and when I say market, I mean economy. When things are changing in terms of interest rates, um, and changes and shifts within the economy and the job space, especially like when you look at retail right now with um, a lot of these retail big box retailers closing, you're seeing jobs being displaced and moved, and sometimes people have to move out of an economy if they're or out of a market if there aren't any jobs to go to. So you want a diverse economy, and this reminds me of North Dakota when oil was up at $140 a barrel. It was over $100 a barrel and went up to 140 something. You couldn't find housing. People were literally pitching tents and living in tents in the North Dakota market because there were a lot of oil and gas jobs, but there was no place to live. And so people were, propping up tents and creating makeshift housing until, housing was built, and they could never keep up. But then it got to the point where they were building so much so fast that the price of oil tanked. And now with oil being in the 40s and $50 range per barrel, we find that there's an excess amount of housing and there's a lot of vacant units up in that area. Why is that? Because it was a smaller market and it didn't have job diversity. So you want a diverse job market. Thirdly, and this is something I talked about before, let's get into a little detail, the rent to value ratio. So what you want is a rent to value ratio that's right around 1%, as low as 0.8% and as high as possible. But really what you're going to find often and what you'd like to see you set as a target is somewhere around 1%. So what is it? So the rent to value ratio is this. If you take a $100,000 house and that $100,000 house rents for $1,000 a month, that 1,000 divided by 100,000 or divided into 100,000 gives you 1%. And so that's what the rent to value ratio is the monthly rent as a ratio of the purchase price or the value of the property at any given point in time. So when you purchase a property, you'd like to stay around the 0.8 to 0.9 to 1% range. That'll give you good cash flow. You know you'll be cash flow positive. It'll give you a decent rate of return. It'll provide a normal cap rate in the 6 to 8% range. As you go above 1%, they're much harder to find. They're out there, but the numbers are going to be more attractive. Now keep this in mind. As you get into lower grade neighborhoods, as you go down into lower income and more rougher areas, you're going to see that number increase. You don't want to do that. That's a mistake. You want to stick to what I'll call A and B class neighborhoods, and we'll talk about that here today, while at the same time sticking to a 1% rent to value ratio plus or minus a little bit. And next is the friendliness of that market to you as a landlord, as an owner of property there. You want to stick to markets that are landlord friendly. Laws should favor you as a landlord, as a real estate investor, because every once in a while, unfortunately, you run into a situation where you have to evict the tenant. Well, not necessarily you, but your property manager. And the faster you can do that and the easier it is to do, the sooner you can turn the property over and get a better tenant in there, or a qualified tenant that is actually paying their rent every month, which is contributing to your cash flow. So this doesn't happen very often, especially in the neighborhoods that I like to focus on, and the neighborhoods that our clients are focused on because of what we're recommending. But you want a landlord-friendly state and a landlord-friendly county. And for the most part, where we operate in, we're going to have laws stacked in our favor. You don't want a professional tenant that knows how to game the system and ends up staying for months and months on end without providing any kind of income to you. So the exception to this rule is, it's not an exception, it's kind of the exception market, is Illinois. We are in the greater Chicago market, and if you're outside of Cook County, it's actually not that bad. So we don't have an issue there. We rarely hear of any issues, and because of the neighborhoods we're in, we typically have very few problems. And so just keep that in mind. You want landlord-friendly markets. Okay, so let's shift our focus to some microeconomic factors, and more specifically, we're going to talk about neighborhoods. This is a huge, huge factor. This is something that is very important, and unfortunately, many investors make the mistake of not paying attention to the neighborhood types. And this plays heavily into your investment criteria. So we typically talk about neighborhood types in 4 or 5 different classifications. I call them A, B, C, and then sometimes D, and then rarely do we talk about it, but an F neighborhood, which is a complete war zone, and we're not even going to talk about that today. The greatest focus I want you to spend your time on are A and B class neighborhoods, but we're going to start by talking about C class neighborhoods. And the reason for that is because we do once in a while have inventory in C-class neighborhoods, and they have their advantages. It's not the starting point, but it's something to be aware of. And so, what are C-class neighborhoods? Well, these are just general rules of thumb, but generally speaking, they're neighborhoods where you're going to have cheaper priced properties. Now, of course, this is going to be relative to the market. You know, a $70,000 property in one market is going to be a $400,000 property in another market, a more expensive market like what we have here in many parts of California. But again, as a general rule of thumb, these are neighborhoods within a metro area that are on the cheaper end of the price scale. For the markets that we're in, generally speaking, these are often under the $70,000, $75,000, maybe $80,000 price range. And so, so from a price perspective, these are the cheaper markets. These are also markets that have higher RV ratios, that rent to value ratios. So what you're going to find is that $70,000, $80,000 property will probably rent for $800 to $900 a month, maybe $1,000, but you're going to see it above 1%. And that's because it's a give and a take. As you drop down into lower and lower income neighborhoods, the rents tend to stay higher than the price points as a whole, which leads to a problem. They look great on paper, and this is why I think a lot of investors make a mistake investing in C-class neighborhoods or lower price, lower income, lower quality type neighborhoods. They just look good on paper. The yields are high, the cash-on-cash returns are very high. It is interesting and certainly somewhat seductive, but it's just not the best place to start. Now, if you have a large, well-diversified portfolio and you want to carve out a percentage of that to put into C-class neighborhoods, that's fine. There's nothing wrong with that, because overall, if you have some issues or you have higher turnover and downtime, that lack of income is not going to affect your overall portfolio performance. But this is certainly not where you want to start. Now, of course, I know people who have nothing but C-class neighborhood properties and do extremely well, but they have a large enough portfolio that there's enough income there that it helps smooth out the ups and downs, or the disturbances they have in their portfolio in terms of performance. But I also know people who focus on nothing but A-class neighborhoods and do extremely well. And that's just, personal preference. That's what they chose. But here's the problem with what I see and what my experience has been with C-class neighborhoods is they have a tendency to have higher turnover and higher vacancy rates. And the reason for that is, and this is pretty much anecdotal, but you just have a demographic of tenant that likes to move frequently. And there certainly is higher turnover, and you're going to have more expense in terms of that downtime, the turnover, and the placement of the new tenant, and also damage done with each turn, because it's not always just normal wear and tear. There's going to be damage that they leave in their wake when these tenants leave. I don't find that in A-class neighborhoods. We have tenants. We seem to have tenants in A-class neighborhoods that care about the property. They have respect for your property, and we never see that. So just keep that in mind. And then lastly, what we often find in these C-class neighborhoods, these lower-end neighborhoods, is an issue with financing. And the reason for that is because, number one, there's not a lot of comparables for the appraiser to use to justify value. And second is lenders don't typically like to lend on low price properties. In fact, they typically have a low end or baseline of the loan size that they are willing to give, and a lot of times that's $50,000, $60,000, maybe $70,000. That's the lowest loan. So that wouldn't even qualify. You wouldn't be able to get that type of financing on these properties. So often investors are purchasing these all cash. There's really no down payment to a loan. The down payment is 100% of the purchase price. And so that's the C-class neighborhood. Now, we break these into we break these down further into kind of three parts. Like we'll call them a C minus, a C, and a C plus. Same thing for B's and A's. We do find a high level of success in the C plus neighborhoods if you want to get granular about this. And on our website, we grade all the property neighborhoods, so you can see this for yourself. But for the most part, C plus and B minus are going to be very comparable. So it's really just a sliding scale, and you just need to understand yourself as an investor. What is your what is your criteria? What is your expectation? What kind of numbers are you looking for? Do you have a certain risk tolerance? If your risk tolerance is relatively low, then you would stick to more premium neighborhoods like in the A's and B plus. So the next type of category is on the other end of the spectrum, and it's what I refer to as an A-class neighborhood, A grade, if you will. And these are your A minus, A, and A plus. Now, these are certainly the more expensive properties, and again, this is market specific. So again, within the markets that we're in, generally speaking, these are properties that are over the $130,000, maybe $140,000 price range. These are nicer neighborhoods. They're very stable. These are typically middle to upper middle income earners. A lot of times they're professionals, nurses. They're people who have what you might label as a white collar job. And these neighborhoods tend to have lower rent to value ratios. And that just goes without saying because the rents don't scale up as fast or as quickly in an appreciating market. And so when you have higher priced properties, you're going to find that the rent to value ratios are going to be either at or below that 1%. It might be 0.9, maybe 0.8, sometimes even 0.7. That's kind of my break point. I don't like to go below 0.8. I'll do a 0.7 if it's an exceptional property, or maybe I'm purchasing it with extra equity. In other words, I'm getting a good discount on it, which we used to find 3-4 years ago, but today being such a strong seller's market, we don't find that happening very often. But the rent to value ratios are going to be lower in an A-class neighborhood. On paper, they don't look as good, especially when we're talking about your cap rate, your capitalization rate, and your cash on cash return, the immediate cash flow, the immediate return on your money, your down payment. However, these properties are more prone to see stronger appreciation because they're just in better neighborhoods that always have strong demand. They have retail demand. They have lower turnover and lower vacancy, which is one thing that investors love. And they basically love the stability of the A-class neighborhoods. They have good quality tenants, good demographics, lower turnover, low vacancy. They're certainly more stress-free for your property manager and therefore for you. And last but not least, they have very few financing issues. Because these are predominantly retail sales neighborhoods, there's a lot of sales comparables for an appraiser to pick from and justify and validate the property value. So these are even easier for us to put our finger on what the market value is, the fair market value of these properties are. And so that's the thing I love about the A-class neighborhoods. But a lot of investors don't want to be there because they either find them too quote unquote expensive. They are not expensive. It's a relative thing. But they're on the higher end of the price scale, and it's really just their rate of return that is not as attractive. So they opt for what I'll refer to as the B-class neighborhoods. And like I mentioned before in talking about hybrid markets, these are a good middle ground. Often what we're going to find is these B-class neighborhoods, the B minuses through the B plus, are going to be from 80 to 130,000. And their RV ratios, their rent to value ratios, are going to be moderate as well. So you're going to find that these are often around 1%. They might be 0.9, they might be 1.1, but the demographic of these neighborhoods and the percent of owner-occupied homes in these neighborhoods are what cause us to label them as B-class neighborhoods. And so it's kind of the best of both worlds. So they actually do look good on paper. They have attractive numbers. They're kind of normal, if you will. They're right within the median expectation of what you would find if you looked across many markets and just looked at what the middle of that bell curve is. So you're going to find cap rates. For those of you that understand that, I assume most of you listening to this understand capitalization rate. It's really just the performance of the property as if you purchased it all cash. So an 8% capitalization rate, if you purchase that property for all cash, no financing, that would be your immediate rate of return, which is essentially the same as your cash on cash return. That's not factoring in appreciation, depreciation, amortization of the loan. Actually, if you're buying all cash, there is no amortization, but that would be your rate of return. And I'm going to give you some actual examples here with numbers in a moment so you can see what I'm talking about. But the thing with B-class neighborhoods is they have a tendency to be low turnover and low vacancy areas. Um, not quite as favorable as an A-class neighborhood, but again, they still have relatively low turnover and low vacancy. So it's not uncommon to have a tenant stay for, let's say, 1 to 4 years. I've even seen tenants stay as long as 7 years just because we kept our rents always just a little under the average or median market rent for that property type. And so we just incentivize them to stay because we weren't raising their rents or raising it much. We always stayed below the neighborhood normal amount, and therefore they had no incentive to leave. So B-class neighborhoods are still easy to finance. There are a reasonable amount of comparables. Often we're going to find B-class neighborhoods to be split pretty evenly between rental units and homeowners. The owner occupied are probably going to be in the 50 to 60% range of that neighborhood, and then the rest are going to be rentals and whatnot. So those are the neighborhood types. Now, here's a personal qualifier when it comes to choosing neighborhoods. And again, this comes down to your personal preference and what you're looking to build and what you want to do. And if you're working with us, our investment counselors can certainly walk you through this and guide you. But here's my personal qualifier, and also this happens to be the personal qualifier for many of my investment counselors. But at the end of the day, if you're investing in a property in a neighborhood, what you would like to see is a retail market. In other words, there's got to be demand for homeowners, the retail market. You want those buyers there, because if down the road, for whatever reason, you needed to sell that property, even if it's not just for the flat out sale of the property, but you're actually selling it to do a tax deferred exchange into another market, because you're essentially just moving your equity from one place to another, you want there to be retail sales. You want to be able to have an exit strategy. So if there's no retail demand, then it doesn't make sense to be in a market, because it's going to be very difficult to sell that property in a neighborhood that has no retail demand. At the end of the day, your probable exit strategy is selling to another investor, and so now you need to make sure the numbers are attractive enough for them to take it over. So for me, if there's no retail demand, I typically don't look at buying that. So I'm going to go through 4 examples here to give you an idea of what I'm talking about with these different markets. Now I'm kind of zooming out and going back to the macro level and talking about markets, not so much neighborhoods. But the neighborhoods play into this as well. So it's not either or. They're really joined at the hip. So I was doing a presentation in Baltimore last year, and this was just an example I picked from Zillow that was just listed. And I use this one because a lot of the people in the audience were from Washington, D.C., which, as you know, is a very expensive market. So this property here, it's a relatively small, less than 1,000 square feet, 3-bedroom, 3-bath home. I don't know how you fit 3 beds and 3 baths into 1,000 square feet. But in either case, it's a really small property that was just listed for $560,000. The rental income on this property was $2,800. It was advertised as $2,800. Now, if you look at this ratio, it's about 0.5, and this is what I would expect in an expensive market like this. Expensive meaning, a $560,000 property for 1,000 square feet. That's very pricey. It's not uncommon to find a rent-to-value ratio of 0.4, 0.5% in the coastal markets. We see it often here in California. In fact, I even see areas where it's down to 0.3, which is incredibly unaffordable. But that's what we're finding. And this is an older property too. It's built in 1947. Now, it isn't in a nicer area. It's a B plus, A minus type neighborhood. It's predominantly owner occupied. So from that perspective, it's really nice. Now I'm going to show you a snapshot of a portion of a pro forma, the actual income and expenses. You're going to see a lot of numbers here, but I don't want your eyes to glaze over because there's really only three things I want you to look at here. All we're showing here are the income at the top, less a vacancy allowance, the expenses, which would be, of course, your property taxes as insurance, your property management, and then budgeting for a maintenance reserve. And then that leaves you your net operating income. And that's the income this property would generate every year or every month if you divide it by 12, assuming that it was free and clear. But most investors love the leverage factor. This is one of the greatest benefits of real estate is you can leverage it using other people's money. So when you deduct your mortgage expense, you end up with a negative cash flow. So there's three lines I want to focus on here. First is your annual and monthly cash flow, as you can see here, is negative. In fact, the carry cost, including the soft costs, which I'll call vacancy allowance and maintenance reserves, those are soft costs. You will spend them eventually, but they're not coming out of your pocket every month, so you may not see them for, who knows, maybe even years. But when you budget for those, you'll see you have a negative cash flow, and this is exactly what we do not want. It's 99% of the time it's not acceptable to have a negative cash flow. There are exceptions, but that's beyond the scope of this presentation. But when we come down here and we look at the cap rate, the capitalization rate is very low. We ideally want to be over 6%, and really we want to be closer to 8% when we can find it, when we can get it. So we're already in a poor position here. The cash on cash return is negative because we're factoring out these soft costs above. But here's the interesting thing about this for those people who love to speculate. And I don't recommend you do that. I'm not a speculator. I certainly don't want you to be a speculator. If, and this is a big if the market continues to appreciate like it has in the Washington, D.C. area, what you're not getting in terms of cash flow, which is, almost $15,000 a year negative, you are making up in the appreciation of this property. So even nominal appreciation on a $560,000 property adds to the total return on investment. So this is everything, the pluses and minuses added together. This is not where I want you to be. I'm showing this to you as an extreme example because a lot of people listening to this are going to be on the coastal markets, the Californias, New Yorks, New Jersey, up in the far northeast, parts of Florida, Miami comes to mind. This is what we're seeing. But let's look at some better examples, some real good examples here. So let's go to a cash flow market. We talked about this, the Memphis, the Birmingham, the Huntsville, the areas like that. We're in a few other markets that we call cash flow markets. So this is a real example. I pulled this right off our website. It's a $75,000 property, very typical. This is a B plus type neighborhood. It rents for $850 a month, so it's a beautiful rent to value ratio of 1.1%. And again, this is a 3-bedroom, 2-bath, 1,300 square feet. I don't put a lot of weight in the age because the renovation work is pretty extensive. So, the mechanicals, the roof are all taken care of. Everything else is pretty much cosmetic. And so when you replace flooring, paint, cabinets, put new appliances, new light fixtures, you basically have a like new property. So I'm okay with anything, in the 60s, 70s, even the 50s in some markets. But look at the numbers on this property. So it doesn't rent for as much as the other property we looked at in the bubble market, but here's the key thing. When you deduct all your expenses, hard and soft costs, you're cash flowing anywhere from $200 to $250 per month. So you're making anywhere from $2,500 to $3,000 per year. And often when I look at these properties, I look at what is the property going to do for me in the first 3 years. I want cash flow from day one, the day I close. I want immediate cash flow, but I also look at what is it doing for me in the first 3 to 5 years. And so when you look at the cash flow analysis tool on our website, every single property has this. We show you the first 5 years, and then we show you years 10, 20, and 30. So we have positive cash flow right from the get-go. And this is just one door. If I have a portfolio, let's say 10 of these, I'm now making 25, yeah, about two, I'd say close to $2,500 a month. That's beyond the scope of this presentation, but I can show you why that would be, because I'm not going to be budgeting maintenance reserves the same way for all my properties if I have a larger portfolio. In either case, here's what I want to focus on: the cap rate. This property is pretty normal at 8%. 7 to 8% is what we're going to see. And that's a great number. If you're at 8% or more in terms of the cap rate, that's fantastic. The cash on cash return typically ends up becoming double digit, so you're going to be above 10%. And then the return on investment is still a very healthy 30 some percent. And this is typical as well. You're going to see your total return on investment when you factor in amortization, appreciation, the tax benefits of the property, along with the cash flow you get every month and every year. Your total return on investment is unbeatable, because where else are you going to find 30 or even 40% total ROIs? So this is a cash flow market. And so you could find these properties if you go and look in Birmingham or Huntsville or Memphis, Tennessee. We carry these all the time. We've been in these markets for over 10 years, and they're perennial markets. Why are they perennial markets? Because they're the linear markets I was telling you about before. Now let's look at a growth market. This is on the other end of the spectrum, but it's not a bubble market. So we have a property here in Jacksonville, Florida for about $178,000. It rents for about $1,400 a month. It's about a 0.8% rent to value ratio, 4-bedroom, 2-bath. This is actually a new build. This is new construction. So if this wasn't new construction, these numbers would actually be a little better than what you're seeing here. But in either case, this is in a very nice neighborhood. It's an A- neighborhood. And as you can see, it's a modern looking new construction property. Now let's look at the numbers. Now, being new construction and being in an A-class neighborhood, we don't expect to see our monthly cash flows or our annual cash flows to be as high as a cash flow market. And often we'll see it a little higher than this. This is just new construction, so we're seeing this below the $200 month, $200 per month mark. But again, we're factoring out a vacancy allowance here. Some people like this because they're going to get, with a high expectation, they're going to get strong appreciation for the foreseeable future, which means the next 2 to 3 years. It's very common to have new construction in areas appreciate for the first 2, 3, 4 plus years, above and beyond what you find in the surrounding areas. But the cap rate here is not great, but it's okay. It's 5.5%, low cash on cash return. And we find that true with all the new construction properties that we build, even the fourplexes that we build in different areas of the country. However, like I said, appreciation is strong and is expected to be strong anytime you're in a development where there's new construction. So the total return on investment is pretty high. It's often in the 50% range. This one is exceptionally high in the 60% range. But Jacksonville, Florida is also a very strong growth market. So you've got several things compounding on each other here. But this is maybe not a typical growth market example, but it's one that I wanted to show you to give you kind of the extreme. And then this is one of my personal favorites. It's really the hybrid market where you have a combination of growth and cash flow. And so this is a property that, I pulled off our website. It's a beautifully renovated. I've actually walked this property. I was going to buy it myself. Beautifully renovated 3-bedroom, 2-bath home, almost 1,800 square feet. $145,000 is the purchase price. $1,400 is the monthly rent. Pretty normal. 1% rent to value ratio. Common, although it's getting a little tighter to find inventory, so we're having a harder time finding that 1%, but it's still there. And not just in Kansas City, Missouri, but in other markets too. Built in the late 60s, A- neighborhood, beautiful property, beautiful street. I remember this, a great location. So you look at a hybrid example like this, and you're seeing your cash flows between $200 to $300 a month. This is what I like to look for and often find. So this is a great little cash cow property in a good market, very stable. This is definitely a middle income, bread and butter community. The cap rate is about 7%. the cash on cash return is close to 10. It's about 9%, but you see as you get into year 2, year 3, your numbers improve. And part of the reason is we're making the assumption that you're going to bump your rent up a little bit. It could be $25 to $50 a month just to keep up with the organic growth in the rents. You don't have to raise the rents, by the way. You could do it like every time you have a tenant move out, which could be every 2, 3, 4, even 5 years. So you could wait just to incentivize the tenant to stay there. But your equity grows because they're paying off your mortgage. They're amortizing your loan for you. So you have the appreciation plus the amortization of the loan. That increases your net worth because it's increasing your equity. Your cash flow will increase, not necessarily every year, year over year. It depends what you do, but it will increase over time. When you look at the total return on investment on a property like this, we could even say, hey, you know what? We're being 20 or 30% generous here in our assumptions in terms of appreciation. And our total return on investment would be in the 40% range, which is still fantastic. But here in this example, it's closer to 53%. So I want you to look at the cash flow when you look at properties and when you make decisions on what to buy. You want to look at the monthly and annual cash flow. You want to look briefly at the cap rate. I don't put a lot of weight on the cap rate because it's so one-dimensional. I like to look at the cash on cash return, and I like to look at the big picture. What is my total return on investment looking like over the first 3 to 5 years? That gives me a good indication of whether that's a good long-term investment. And of course, I put a lot of weight on the neighborhood grade. I like personally to stay in the A minus, B plus, maybe the B category neighborhoods. But again, when you have a conversation with your team that you assemble, whether it's us or whether you assemble your own team, these are the conversations you want to have and the things you want to look at. So this is the purchase process. I like to take a top-down approach, and this is exactly what we go through with all of our clients when we have a strategy session and we get into our client's head to understand where they're at, where they want to go, what it is they're trying to achieve, what their risk tolerance is, how much investment capital you have to start with, what is your capacity, which is a combination of investment capital and your credit, and that's important if you're financing. So these things, are all things we just want to explore with you and pull out of your head. Now, if you're doing this on your own, this is the process. You want to start off by defining your goals and listing out what your investment criteria is. Sometimes people make their criteria too strict and you're just not going to find what you're looking for. Sometimes your criteria is a little bit too loose and open-ended. That's fine. You'll have a lot of prospects to look at, but you'll narrow that down as you start to evaluate properties and look at more and more of them. But you want to define your goals, look at where you're trying to go to, what are you trying to achieve, and break that down. Just kind of reverse engineer it and figure out how much you need. I just recorded a podcast recently with a client from 4 years ago. His name is Anton. Relatively young guy. He's in his 30s, but he started off when he came to us. I worked with him personally, and he had no properties. He purchased 4 properties right from the get-go as quickly as he could, and he continually built that up. Him and his wife saved as much as they could. They increased their income as much as they could, as fast as they could, and they kept accumulating more doors, single-family homes, duplexes, fourplexes. So today, 4 years later, starting from nothing, getting into 4 as quickly as they could, they now have 35 doors under their belt, and their passive income today is over $10,000 per month. So this is very doable, and if you have a methodical approach, you have a step-by-step methodology, which is what I created for myself back in 2003, 2004, and this is what we share with other people, and this is what I'm talking to you about today. If you follow that process, you can do it. So once you've decided on what you want to achieve and what your goals are and what your criteria is, in other words, what markets are going to meet your goals and what you want to focus on, then you got to start deciding on what is the best market. You might like 3 different markets, but you got to pick one to start with and see if you can find the properties in the neighborhoods that are going to meet your criteria. And if you can't, after assembling a team, achieve that, then you might have to look at a different market. Then you need to assemble your team. So who's on your team? If you're working with a company like ours, a premier provider of turnkey rental properties, we're going to provide you everybody you possibly need to be on your team. They're already vetted people. But if you're doing it on your own, you'll want a professional on the ground, boots on the ground, like a real estate agent who is an investor themselves. This is very important. You want a real estate agent or somebody who is renovating properties, like a professional, larger scale rehabber that is flipping essentially turnkey properties to investors. So that is a critical component. You want someone who really understands the neighborhoods, the types of property, what a good rental is. You don't want a property that's just rent ready, because there's a lot of rent ready properties on the MLS. You want a property that is either brand new or like new. You don't want any deferred maintenance. So when you're working with a real estate agent or a rehabber or someone else on the ground, they need to understand real estate investing. They should ideally be a real estate investor themselves. They need to know what to look for on your behalf, but you need to also ask the right questions. And you want to make sure that you understand what it is you're buying, but you need to give them that criteria as far as what you want. So there is your source for the property. Then you want professional full service property management. Again, you'll want to heavily vet your property manager. They're going to be the most important person on your team. Absolutely important. Property management is your make or break. I jokingly say you live and die by your property manager. So you can have a decent property in a neighborhood that's not so much the best place to be, but if you have great management, they can qualify and screen good tenants to be in there and make that so-so investment a good investment. So this is how important the property manager is for you. You'll want professional third-party inspectors. You'll want lenders who only specialize in working with real estate investors that do non-owner occupied loans. Wells Fargo, Bank of America, they're just not going to cut it. They have what are called overlays on top of their loan criteria. They don't do investment loans very often. You need to work with someone who specializes in doing financing for real estate investors. That is so important, because I can't tell you how many deals I see fall out of escrow at the 11th hour because things come up that weren't thought about or even asked in the very beginning, and so you just end up wasting 30 to 45 days plus the cost of an inspection plus the cost of an appraisal. So having a lender and or mortgage broker that specializes in working with real estate investors is critically important. And of course the title and escrow company. And I'm not sure if I missed anybody there, but there's probably some other people that you want on your team to make this a hassle-free, smooth process. Then when you have all that done, you want to start choosing, shortlisting properties, doing your analysis and due diligence on them, and then selecting the properties that are the best candidates, and then ultimately submit a contract on one, maybe two, but submit your offer on one or two of those properties, and you will continue to do your due diligence after that. But you want to analyze everything up front and make sure that it's in the right location and it looks like it's in the right condition. You haven't done an inspection yet, so don't worry about that. But you want to analyze the numbers, you want to analyze the location, you want to pull up neighborhood information, demographics, different types of factors that are important to you about that neighborhood. There are many websites out there like Neighborhood Scout and the Bureau of Labor Statistics and so many other websites that have information about markets and neighborhoods. But do your analysis, select your properties, put one under contract, and then at that point what you want to do is order a third-party inspection right away. You want to inspect that property from top to bottom and really understand what you are getting. Now, when you get the inspection back, you want to make sure that there are no red flags. I break things up into things that must be done, should be done, and could be done. You'll always have things on that list that could be done. You're never going to get an inspection report back from an inspector that is completely blank, because it looks like you paid for nothing. So there are always going to be things on there. Sometimes they go overboard and being ultra picky, but what you'll notice is that they're ticky-tacky type items. They're just a bunch of things that are not going to affect the suitability, rentability of that property. But what you want to look for are must be done items and things that should be done. Those are going to be points of discussion with the seller of the property. And often, at least with us, those things are always taken care of. If something comes up that was missed, they're going to be dealt with because of our relationships with our teams on the ground. and the leverage we have on them because we provide them a lot of business and they treat our clients exceptionally well because they know that we are an important source of business for them. If you're doing this on your own, you don't necessarily have that leverage unless the team you have is can influence them and has that leverage on them. So have your inspection done. If you're financing the property, the appraisal will need to be done at the same time. It doesn't matter if it's before or after, but around the same time, because you need to get that into underwriting, because the underwriting can take a while before you get your financing and get your property funded. And of course, you'll want to verify the numbers. You want to verify the property taxes. You want to shop for insurance, get insurance quotes. You'll want to confirm that the rents coming in are the rents that are being collected. You want to look at a copy of the lease. You just want to verify everything, just like Ronald Reagan said, trust but verify. You want to verify everything at this point because now you actually have 7 to 10 to maybe 12 days to do your due diligence as per your purchase agreement. So it's on the contract. You need to get it done. And so now you really want to get that part going. And then once you are near the close, you've done all your inspection, your verification, everything checks out, and you're ready to close, you want to have your conversation with your property manager to get a management agreement, review it, sign it, and get that in place. It's important to have a conversation with the property management company and ideally a property manager that is in the management company and understand their processes, their services, what they charge for, how they operate, how often they communicate with you, etc., etc. So again, the management companies we work with in each of these markets, they have already been vetted and they have a long history with us. So we don't have any issues with them. But these are all the things that you need to do in investing, whether it's locally or out of state. And then lastly, rinse and repeat. Once you've gone through this process, it becomes easier and easier every time you do it. But you don't want to skip any of these steps. And keep something in mind. When you need to be agnostic. Our company here at Norada Real Estate, we're market agnostic. We're not married to any market, but we're also not married to any provider. There is no service provider that we benefit from. So we are free to hire and fire property managers, builders, turnkey operators that we work with, that we've aligned ourselves with, title companies, lenders, you name it. We're completely agnostic, and that allows us to be nimble and allows us to be unbiased. So whether we're investing for ourselves or investing or helping our clients invest, we can always make the best decisions because they are unbiased and they're in alignment with your goals and criteria. So just keep that in mind. You don't want to be married to anybody, but you want to have a good, trusting relationship. So let's wind this down here by just covering a couple things real quick, just so you understand our ecosystem. Our company has been built for the last 14 years to be a full-service turnkey provider of rental properties. We're nationwide. Everything we sell is cash flow positive. We offer new and newly renovated properties. They're all leased or to be leased. Sometimes they're under renovation, so they can't be leased, obviously. And last but not least, and critically important, is they're professionally managed. The other thing we do from time to time is we have a private lending program. Not always, but we have been paying up to 15% on notes that are secured by deeds of trust. This is just a simple lending program. And then thirdly, from time to time, we have group investments, what some people call syndications. Right now, we are funding not one, but two cannabis-related investments. Of course, real estate is involved. There's a building, there's land. But whether it's an apartment complex or it's a 20-pack of homes, we have these group investments from time to time where this is the ultimate in terms of passive real estate investing. So there's always cash flow and there's growth involved in this. But those are the three things. But the core business is really number one here. It's the turnkey, the turnkey rentals. That is what I started doing 14 years ago, and we continue to do today. And we cover almost 17 markets today. So what's next? I'm going to say there's two things, two next steps, if you will. I'm a big believer in education. I think you should always be building your knowledge and continuing your education. I'm a perpetual student of real estate investing and investing in general. I love to study economics, marketing, real estate, market cycles, gold, silver, you name it. I love that stuff. So I'm a perpetual learner, and I think you should be too. But I created this report, this guide called The Ultimate Guide to Passive Real Estate Investing. It's about 42 pages. It's a free download, and it is a fantastic primer. It covers everything we talked about today and then some in print. And what I did is I just wanted to educate people on what to look for and how to do what I did in kind of a mini book format. And so you can download this on our core website, our real estate website, and you can just go to turnkeyrealestateinvesting.com and you'll find the download. There's an image, but there's a download link there and a button. So I highly recommend you download this 40-page report. This guide will help you. It's a great, great primer. And last but not least, the next thing I want to suggest in terms of continuing your education and just being dialed in is subscribe to our top-rated podcast. We have one of the top-rated real estate podcasts on iTunes. We have well over 500 five-star reviews, and we're constantly told how great the content is. So I've started right from the very beginning in episode 1 on what is passive real estate investing, what is turnkey real estate and turnkey real estate investing, and I just go into literally like a chapter of a book on each and every episode. And so that podcast is actually being turned into a book here very soon, which will be a full probably 200-page paperback that will be available on Amazon, Barnes & Noble, and wherever else. So that just keep your eye out for that. I'm not sure how we're going to market that, but it might be a free plus shipping offer, so I'm not sure. But you can subscribe to our podcast and go to the podcast website, which is chock full of content as well. That's at passiverealestateinvesting.com. So I hope this has been helpful. If you have any questions, by all means contact me or my staff. I have 6 or 7 investment counselors that are happy to answer questions, and we all eat, breathe, and sleep the same information here. So, real estate has been great for me, and it's just created a lot of freedom for me and my family, and I hope to do the same for you too. So. If you have any questions, contact us through our websites. And, remember what I always say, live where you want, but invest where it makes sense. Thanks for listening.